Welcome to the Deep Dive, where we cut through the noise and get straight to the insights. Ever wonder how some companies manage it? Not just growing, but thriving for decades. Consistently great financial results, but also keeping this distinct culture, this clear philosophy. How do they even pull off massive takeovers without, well, losing their soul? Today, we're going to peel back the layers on a real standout, Markel Corporation. We got some fascinating stuff here, excerpts from their 2013 annual report, plus a whole collection of their shareholder letters. Our mission, to really get Markel's unique mix of insurance and investing. We want to dissect the strategies behind that long-lasting growth and uncover the principles that make them so compelling. Get ready, because this deep dive offers some incredible lessons, really actionable stuff for building value, whether you're running a big company or just managing your own finances.
Oh, absolutely. The Markel story. It's like a masterclass in patient long-term thinking. It's such a contrast to the short-term buzz we see everywhere else. And these sources, they give us this rare window into a company that genuinely sees its shareholders as partners, real partners. They prioritize sustainable value, lasting value, over just hitting the next quarter's numbers. It's an approach that, honestly, once you dig into it, it really changes how you think about business success.
Okay, let's unpack this then. Before we even touch the numbers or the big acquisitions, we really have to talk about the core, the essence of Markel. Right at the start, they tell their shareholders, this is your company. We as managers are stewards of your capital. Wow, that's a pretty bold way to frame the relationship. So what is it about their fundamental business philosophy, their soul, if you like, that sets them apart from, well, the usual corporate speak?
What's really fascinating is how they talk about the Markel style. It's not just some slogan on a poster. It feels like a genuine creed. They describe it as hard work and a zealous pursuit of excellence while keeping a sense of humor, and also honesty and fairness in all our dealings. You get the sense this isn't just marketing fluff. No, it seems like the bedrock of their culture. It shapes decisions day to day, strategy long term. They even mention Jim Collins' good to great idea, distinguishing between companies that are real teams versus those that are just a genius with 1,000 helpers. Markel strongly identifies as the team. They argue it just produces better, more durable results in the long run. It makes sense, right? Collective effort, more resilience.
Right. So it's this collective drive, strong values, bit of humor mixed in, that sounds absolutely vital for building the kind of trust they mention with shareholders. They even say it's fun because of that partnership. But how does that team thing really translate into actual business decisions? Is it just about being nice, or does it tangibly impact results?
Oh, it's way more than just being nice. That team-first, high-trust culture means when things go wrong, and they inevitably do sometimes, people aren't blaming each other. They're working together to fix it. And that fairness, it's everywhere. How they treat customers, employees, how they talk to investors. That consistency builds this incredibly valuable reputation. It makes them the people others want to do business with: clients, employees, even companies they might acquire. It means they attract good people who actually believe in this way of working, which then feeds back into better results. It's like a positive loop.
Okay, here's where it gets really juicy. 2013. Markel themselves called it a fabulous financial performance year. They even used the word transformational. Those are big claims for an annual report. So give us the highlights. What made that year so pivotal?
Financially, 2013 was exceptional. A real landmark. Total revenues shot up 44% to $4.3 billion. When you just think about that. For a company their size, 44% isn't just growth, it's explosive. Comprehensive income, which gives you that broader picture of total earnings, including some investment gains, hit $459 million. And maybe the most important metric for long-term investors, especially in insurance, book value per share, basically assets minus liabilities per share, grew a very healthy 18% to over $477. But the really huge news, the transformational part, was definitely the Altera acquisition on May 1st. That one deal basically doubled the size of their insurance operations overnight.
Doubled. Wow, that sounds intense. A lot of companies really stumble trying to integrate something that big. Culture clashes, customer service drops off, yet Markel pitched it as scale-enhanced, business as usual. How realistic was that, especially for a company so focused on its unique Markel style and trust? What did they really have to navigate?
That's a great question. They absolutely knew the risks, especially culturally, with such a massive acquisition. Their response was very deliberate, that scale-enhanced, business-as-usual message. It was aimed right at customers and investors. Manage expectations, minimize the jitters during integration. It really highlights their disciplined approach to growth. They were determined that this huge expansion wouldn't wreck their existing operations, their service, or those core values. They're also super clear in their communications. They even put a Twitter version summary in the report, something like, 2013 great year. Doubled insurance biz W Altera. Rest of Markel grew double digits. Expect more. It wasn't just spin. It was about showing stability and keeping trust high during major change, proving the core philosophy was solid even during transformation.
Okay, let's dive into that core engine then, insurance. The report really hammers the idea of profitable revenues, not just growth for growth's sake. They state any and all revenue must carry with it the expectation of profitability. That's a pretty fundamental point, often lost when companies just chase size. How do they actually do that, especially while expanding so fast?
Yeah, they're very explicit about it, just slashing prices to write more premiums. That's a quick road to ruin in insurance. You have to cover claims eventually. So in 2013, their gross written premiums, that's the total premiums collected, jumped 56% to $3.9 billion. That included a solid 7% organic growth from their existing book, plus the big chunk from Altera. But crucially, like you said, it was profitable growth. We see that in their combined ratio. For listeners, that's basically claims paid plus operating costs divided by premiums earned. Below 100% means you're making money on the underwriting itself. And Markel stayed steady at 97% for both 2013 and 2012. That's impressive, especially considering they had one-off costs from the Altera deal baked in. They put this consistent profitability down to several persistent advantages.
A 97% combined ratio with acquisition costs. That definitely signals strong underwriting. So what are these persistent advantages they talk about? How do they make sure they're profitable, especially when bringing in a huge new business like Altera?
Right, connecting it back, it really boils down to a few key things baked into their DNA. First, just really thoughtful risk selection and pricing by their underwriters. These aren't salespeople chasing volume. They're experts carefully assessing each risk. Second, better IT. They mention things like their broker portal, making business faster and cheaper to process. Efficiency matters. Third, the increased scale from Altera did give them more opportunities across more markets, which helps if managed well. Fourth, strong marketing built on that reputation attracts better clients. And finally, the reputation itself. It builds client confidence. People trust them. Plus, they stress their unchanging standard of conservatism in setting loss reserves, the money put aside for future claims. They deliberately aim to be more likely to be redundant than deficient, meaning they'd rather set aside a bit too much than too little. It protects the balance sheet, keeps them super solid, even if it makes reported earnings bounce around a bit more year to year. Classic value thinking.
Okay, so beyond the insurance engine, Markel's also this major investor, right? People sometimes call them a mini Berkshire. They talk about having a 360-degree range of choices for putting capital to work. For you listening, what does that actually mean? What are these unique choices they have that maybe other companies don't?
Yeah, that 360-degree idea is a huge differentiator. It's where Markel really shines. Think about it. Most companies, they've basically got their shareholders' equity owners' money, past profits to invest and grow. Markel, being an insurer, has two pools of capital. They have their own, sure, like everyone else, but they also have the float, the premiums collected that they hold on to before paying out claims. This float isn't technically theirs, it belongs to claimants eventually, but they get to manage and invest it in the meantime. It's like an interest-free loan, a massive strategic asset. This dual engine gives them incredible flexibility. Their choices for using that capital are 1. Organic growth in existing units, 2. Buying whole new businesses, often outside insurance, 3. Investing in stocks and bonds, and 4. Buying back their own stock if it looks cheap. And the amazing thing, in 2013, they did all 4, actively. It really shows how they think about creating value from multiple angles.
Having that float to play with, that's a fascinating edge. So how did this investment strategy actually perform in 2013, especially given the market backdrop then?
Well, the total investment portfolio grew to $17.6 billion. And Altera brought in a big chunk, about $7.9 billion of that. But the real standout number for the year was a stunning 33.3% return on their equity investments. Stocks. And that's not just a lucky guess. Markel's dedication to disciplined long-term equity investing is pretty unusual for an insurer. Many stick mostly to safer bonds. They follow this clear 4-part checklist for stocks. Profitable businesses, good returns, low debt. Talented ethical managers, businesses that can reinvest earnings wisely or manage capital smartly. And crucially, getting all that at a fair price, it's pure long-term value investing.
Okay, 33.3% on equities is phenomenal. But what about the fixed income side, the bonds, which, as you said, is usually the bigger piece for insurers? Did that do as well?
That's where it gets even more revealing about how they think differently. In fixed income, bonds, they earned 0% total return in 2013. 0. But this wasn't a mistake. It was absolutely a strategic decision. For years leading up to this, they'd been voicing concerns about interest rates being artificially low, bad for long-term returns, distorted markets. So what did? They got defensive, built up cash, stuck to shorter-term bonds, giving up some yield for safety and flexibility. Then, just as they expected, rates started rising in Q2 2013. When that happened, existing longer-term bond values generally fell. Their cautious stance meant their bonds fell too, leading to that zero return.
Yeah.
But here's the key. It left them sitting on a pile of cash, ready to reinvest at the now higher, more attractive rates. They specifically mentioned seeing opportunities pop up in things like distressed municipal bonds. It's just classic patience and opportunism.
That really is preparing for the rain while the sun is shining. And their whole view on market volatility seems different too, right? Most investors, definitely big institutions, seem terrified of ups and downs.
Exactly. They state it plainly. They are not irrationally afraid of volatility. That's a core philosophical point. They argue that chasing stability by sticking only to less volatile things like bonds might make quarterly earnings look smoother, but it would seriously crimp long-term profitability and value building. A lot of their equity success, that 33.3% we talked about, comes from unrealized gains. These are profits on stocks they still own. They haven't sold yet. Now, these don't hit the main income statement right away, which can make quarterly results look jumpier, but they steadily build up value on the balance sheet, and it's incredibly tax efficient until they actually sell. They pointed out a $1.7 billion unrealized gain on their stocks at the end of 2013. That meant over $500 million in taxes they hadn't paid yet, money still working for shareholders. Their punchline was blunt. They'd happily trade a little volatility and reported net income for $500 million anytime. It just shows that laser focus on real economic value, not just accounting neatness.
So with all this going on, the insurance, the big investment portfolio, these other non-insurance businesses, how should we, whether we're investors or just trying to understand, actually value a company like Markel? They mentioned a subtle shift in what they want investors to focus on. What's that about?
That's a really important point, and it gets to how you track success in a business that's changing. Markel themselves started shifting focus away from just the absolute book value per share number towards looking at the 5-year compound annual growth rate, the CAGR, in book value per share. Why the shift? Because Markel isn't just an insurance company anymore. It's evolving. While their traditional insurance units are still pretty well represented by standard GAAP book value, that's the accounting rules, their growing Markel Ventures arm is different. These are the non-insurance businesses, remember, like Weldship, Parkland, Partner MD, Retail Data. These kinds of operating companies are better valued based on the cash they generate, their earnings power. That shows up more in the income and cash flow statements, not just the balance sheet's book value.
Ah, okay. So the traditional insurance accounting doesn't quite paint the full picture anymore now that they're more diversified.
Precisely. You nailed it. Things like buying back stock or issuing new stock for acquisitions can sometimes distort that raw, static book value number. It makes it a less perfect yardstick on its own for a growing mixed company. But the 5-year growth rate, the CAGR, smooths things out. It gives a more consistent, directionally correct surrogate measure, as they put it, of how well all these different parts are actually creating economic value over time. It gets past some accounting quirks and gives you a more dynamic view. They used a great analogy. Say, 2 companies both have a $100 book value right now, but one grew that book value at 8% a year for the last 5 years, and the other grew at 12%. You'd rightly conclude the 12% grower is doing a better job creating value and is probably worth a higher price multiple. That growth metric forces you to look at the trend, the momentum, not just a single snapshot.
Right. And besides that huge Altera deal, Markel Ventures kept growing too in 2013. They bought Eagle Construction, a home builder in Virginia. This continued diversification, adding non-insurance pieces, that seems like a core part of their future plan.
Oh, absolutely. Markel Ventures is key. It's their strategic move into totally separate industries. It gives them another really valuable place to allocate capital and build value over the long haul, separate from insurance cycles or stock market swings. And that Eagle Construction deal, it wasn't just random. It actually grew out of a long relationship they already had, including a previous joint venture. It shows how patient and thoughtful they are about these acquisitions too. This diversification, it helps lower the overall risk profile of Markel Inc., spreading their bets while opening up totally new avenues for growth by owning these high-quality, standalone businesses. It's really about owning a collection of great, diverse companies.
So looking forward from that point, after such a massive year, what did Markel signal about their priorities for 2014 and beyond?
They were pretty clear. Continued heavy investment in technology across the board, a relentless focus on serving customers well, especially with fair and fast claims handling, and really working to be valuable partners, valuable suppliers in all their different businesses. But they also made it crystal clear. While processes would change, technology would improve, they'd expand geographically. The core Markel style, those foundational values, those were constant, non-negotiable. That unwavering commitment, they believe, is what keeps attracting wonderful associates. That's what they call their employees, and what ultimately guarantees continued, sustainable success for the long term, no matter how big or diverse they become.
What a deep dive indeed. We've really seen how Markel navigated a truly pivotal year in 2013. It wasn't just about pulling off a huge acquisition. It was about doing it while sticking to this deep-rooted philosophy. Teamwork, smart capital allocation, always keeping that long-term view on value. For you listening, this isn't just an insurance company story. It feels more like a blueprint. A blueprint for how patience, having a clear strategy, and really committing to your core values can build something incredibly successful and lasting, even when things are changing fast.
Absolutely. The lessons here, they really do go way beyond finance or business school case studies, whether you're trying to build your own business, manage your investments, or heck, just make sense of all the information flying around. Markel's approach has so much to offer, focusing on profitable growth, not just size, understanding the why behind the numbers, and just having that thoughtful, patient, long-term perspective. It offers immense value.
So what does this all mean for you? As we saw with Markel, the metrics we use to measure value, they sometimes need to change as the thing we're measuring changes. Markel shifting emphasis from just book value to the growth in book value. That's a perfect example of adapting how you measure success. So here's a question for you to chew on. In your own world, your job, your investments, maybe even personal projects, are you really focusing on the metrics that capture true long-term value creation? Or might you still be relying on older measures that honestly might not be telling the full evolving story anymore?